I'm Dr. Mike Fuljenz, and I recently met with Steve Forbes, editor-in-chief of Forbes Magazine, a prominent business publication. Mr. Forbes was also a candidate in 1996 and 2000 for the Republican presidential primaries and so much more. He is also the co-author of the book Inflation with Nathan Lewis and Elizabeth Ames that I highly recommend. We have copies of the book available, signed by Steve Forbes and myself. I was honored to talk to him in Nashville along with Nathan and Elizabeth. The first question I asked Steve was, you once played Merlin the Magician in the play Camelot alongside my friend Gary Alexander, who played King Arthur. Using your powers of wizardry, what is the highest you could see gold during 2024?
Well, first on that Merlin thing was a very short version at a thing called Freedom Fest. And while I was in the play, I did keep my day job. And so I know where my real talent is. It's not on the stage. But in terms of predicting the future, one other thing before I even venture a number is a favorite saying of my grandfather, who founded our magazine. He was an immigrant from Scotland 106 years ago. He liked to say, we make more money selling the advice than following it. So I'm covered with the regulatory authorities. But in terms of the gold price, I think it'll be well above 2,000, probably reaching 2,400. But these things are hard to time, so if it isn't 2024, it's going to be soon thereafter. The reason is that even though the Federal Reserve has been tight recently, if the economy doesn't improve and the wrong side wins next year, or the good side doesn't win enough, then they're going to be spending again. And how do you finance spending, excess spending? You either do it through taxes, which will be blocked, or you do it through borrowing. The markets are going to be resisting a little bit, and you do it through the Federal Reserve buying bonds again. And how does the Federal Reserve pay for bonds? They pay for it by, in effect, borrowing short-term, creating the money out of thin air. So when you do that, we know what happens. When you print too many dollars, guess what happens? It goes down in price, which means you have inflation. Then you have non-monetary inflation, where they throw in, they make things more expensive. So gold is due to go up, even though the real value of gold remains very steady. When you see that price move, it's the price of the currency. The value of the currency is changing, not the value of gold.
Thank you so much. Well said, and right out of your book, and many of it with little enhancements, which I really like. On page 29 and 30 of your book, I was inspired for this question. You played President George Washington in a play at Freedom Fest. And Washington once said, he appealed to the Continental Congress for supplies and money for the Army. And he said a wagon load of Continentals could not buy a wagon load of provisions because the original currency had been inflated so much, it took a wagon load of Continentals to try to buy a wagon load of provisions. October marks the 100th anniversary of the German hyperinflation of 1923, which you mentioned in your book. Do you think the U.S. will ever be in danger of a similar fate again?
Well, one of the reasons the U.S. tied the dollar to gold and silver, mostly gold, was precisely the hyperinflation that came out of the American Revolution. And that's why for years they had the phrase, not worth a continental. Sadly, that's gone out, and we've had a terrible inflation starting in the 1970s, and we did not go back on a gold standard, and we've been paying the price for it ever since. So in terms of a hyperinflation, I think maybe Nathan will have a different opinion, but I think we'll avoid it simply because people react instantly now when they start to see trouble. I think the pressure of events is going to not enable them to do what happened in Germany in the 20s, where they were so ignorant of it that the central bank actually thought we're not printing enough money because prices are rising faster than the money supply. And so they misjudged the whole thing, and we know what the consequences were.
Thank you so much. Nathan, do you have a comment?
It's true what Steve says is that people are more careful about these things now, I think, in terms of the way markets react and so forth. But I think there's a possibility that they could just just one day they won't be able to sell all the bonds they had on the menu to be sold, but they still got to pay checks for Social Security and soldiers and whatnot. And just that one day, it'll just have the Federal Reserve cover the difference. And who knows, maybe the next thing happens the next day, the next thing happens. Same thing happens the next day. And so I think there is risk of these things, even though I think sometimes in the gold community, you always say, oh, hyperinflation is right around the corner. It's not really true, but I think we are at risk of that over the next, let's say, a 10-year window.
Thank you for qualifying that for us, both of you. So including problems like the increasing national debt and entitlement issues with entitled programs, and the interest on the national debt, you feel that the other forces around would contain it some, because the debt and the currency that comes with it is pretty serious.
Well, it is serious, and but I think we should have learned what's happened with countries with high debt levels that did it right. The British, after the Napoleonic Wars, had debt equivalent, they figure, over 250% of GDP. They kept the pound on gold when the conflict was over, had pretty good finance for 100 years. So by the time World War I came, the proportion was about 25% of GDP. After World War II, 121% of GDP. By the late 60s, early 70s, down to 35. So the way you do it is through growth, through tax cuts, stable money, deregulation, instead of the craziness that they're doing now. And the amazing thing is, when you hear these horror stories about the entitlements, if you have 3.5% growth on average, certain years will be better than others, but 3.5% average, which we've done in the past many, many times, though those crises become far less severe. You can deal with them. You can put in a new system for younger people. And on healthcare, the answer is not shooting everyone over the age of 80 and saying to cure Medicare problems. The way to, or root canal without anesthesia equivalent, the way you do it is free enterprise in healthcare. There is no free enterprise, or very little. It's all third party. A hospital gets its revenue not on satisfying you, the patient, but on how well they negotiate with insurers and the federal government. That's beginning to change for a variety of reasons. I think in the next 5 to 7 years, you're going to start to see a real consumer market in healthcare. So the solution is growth. How do you get growth? Stable money, low tax rates. How do you get the healthcare problem solved? Let the free markets work. You know, one example, LASIK surgery on the eyes costs today, even in nominal terms, less than it did 20 years ago, with a better result. And the reason is, not only is it lower in cost, because it's not covered by traditional insurance, which means providers have every incentive to make it more affordable and to give you a better result. Let's do it for all of healthcare. Get the best of all worlds. Make the patient in charge. That's a long way of saying these problems are solvable, not by root canal without anesthesia, but by appealing to our strength, which is entrepreneurship.
Media often says that gold is negatively affected by rising interest rates, but it rose sharply in 79, 04, 06, 17, and this year. Are rising interest rates typically bad for gold prices? Your thoughts?
Well, gold price is determined by what you're doing to the currency. And we saw in the 1970s very, very high interest rates, and we all saw what happened to gold. It's not interest rates per se. It's what you're doing to the currency.
Exactly. I appreciate that. What type of gold standard would be most practical in the U.S., and what are the odds of that happening? And what presidential candidate out there right now has the best chance to put us on some form of gold standard?
I think with the presidential candidates, all need, let's call it education. They're just at the beginning of the learning curve. Mm-hmm. But I think the fact that things are not working the way they're supposed to be, I think a couple of candidates now or in the future are going to say, I got to do something to distinguish myself from the others, think new ways of doing things instead of the rut we're in today. So on a gold standard, the key thing is you fix the dollar to gold, which means is if the gold price starts to move in the market, you take corrective measures, whether it's up or down. Fairly simple. Tools may change, but the goal is the same. Keep the dollar steady. And the reason is, as you know, for a variety of reasons, gold keeps its intrinsic value better than anything else in the world. As for 4,000 years, the way you mine it and everything else, not too rare, but rare enough and everything else. And so I think we'll go back to the gold standard, but we need a lot of education. That's why we wrote this book in a very straightforward way. It was precisely, if tomorrow they said, we need a gold standard, they wouldn't know how to run it. And in the 1960s, the US misran the gold standard. The Brits did it before World War I fairly well, but again, we got to relearn how to do something right.
Do you think gold would go up significantly as they implemented a gold standard?
I think the markets would, what you probably would see, that they've made the decision to go on a gold standard, would be things were so bad that the markets anticipated a lot of trouble and ran up the price. Just as you saw in 1970, 1980, gold soared at what, $870, $880 an ounce in anticipation. These people didn't know what they were doing. Finally, in 2 years, we got it right and it went down. So it depends on the circumstance. But the gold price in nominal dollars would be higher today than it is going to be in the future when we go back to a gold standard.
So Forrest Hamilton here has a question for you about that ties into the gold standard. What's your question, Forrest?
So you mentioned BRICS just a moment ago. That's for those who don't know, Brazil, Russia, India, China, South Africa, and their push to get away from the US dollar. How do you see them? I mean, I've read that they're talking about doing some type of a crypto, type of a exchange. How do you see them, and what's your thought on that, the BRICS?
Well, the only way you would trust a currency from that crowd would be as if they had backed 100% by gold, sort of a currency board with gold, and the Swiss located in Switzerland under Swiss law. You wouldn't put such a system in Moscow. You wouldn't put such a system in Beijing and have any confidence, or Delhi. It'd have to be in a place where people feel you really can't muck around with it.
Right.
But other than that, no, it's going to be tough. Nathan has written on China's been interested in it, but so far they haven't really made the full push for it. And India, tell them about India.
Oh yeah. India is starting to issue gold government bonds, which I think is very a key element of this whole thing. Because and plus also I think it could be a very popular investment, because if you bought a 4% gold government bond in 1968 and it actually paid out, it would be one of the best performing assets of the entire 50-year period. So
We've only got a few minutes. I want to ask a few quick questions. In your book, you say that ETFs of gold may not be 100% backed by gold. Want to be concerned? You still hold by that position?
Well, Steve has maintained, and I would assume that you are in a concurrence, it's not about backing, it's about the maintaining of stable value. So basically, Steve, want to elaborate on that?
Well, the key thing is, one of the problems with some cryptos out there now that say backed by treasuries is, where's the beef? What is actually there in the cover?
Okay, Claire, Bell.
Well, you said it was there, it wasn't. So you have to have people have to see transparently that it's there. But gold-backed crypto would be good. But in terms of investing in gold itself, I think, Nathan, you've made the point that probably it's not the gold company, not the gold mining companies. You should either actually own it physically.
Yes. You know you have it, whereas you may not know on the others. Crypto. I know people who are getting bills from the IRS for crypto trading in small amounts a few years ago. Have y'all heard about that? I mean, I have a friend who just got a bill for $5,000 from the IRS for a small amount of crypto trade. He didn't make $5,000, much less a tax bill of $5,000. Probably going to pay it just because it's not worth the hassle. Do you think that will diminish or put a crimp on crypto trading?
Well,
For aggressive IRS on going back and discovering that, crypto trades.
well, yeah, you'll see that. But the key thing to keep in mind is, if crypto looks like makers get their act together where you can actually easily use a cryptocurrency, not only for daily transactions, but long-term contracts, they're going to fight it tooth and nail.
The U.S. government may get into it.
Because they're going to try to fend it off. But one, you don't want a government crypto or a digital asset. And number two, they're going to see a real regulatory battle.
Do you believe the average investor should have some physical gold in their portfolios? Yes or no?
Yes.
Okay, y'all agree?
Everyone should have the experience of owning something directly, not just having numbers in a brokerage account or bank statement.
And I'm going to say something. I know people who've been in Fort Knox, and there's a lot of gold there. For those of you who don't think there's gold at Fort Knox, would you agree with me that there is gold in Fort Knox?
Yes. And
Okay.
and even if Goldfinger had been successful in putting the setting off that the atomic stuff in Fort Knox, making it toxic, it would still be usable because people would know it'd be there. You don't have to physically own it, just have to know it's there.
There you go. Thank you.
I have one question real quick about he asked you a little bit about the predictions of gold. What do you see for younger people for investing in gold, and what is a price point? Because a lot of people get into the market, like this crypto stuff, they get in the market to make a quick buck, but what do you advise people who are just now getting into buying gold, and what is the ROI, so to speak?
Well, if you're going to, as a young person, one, put money into a 401k, IRA, or whatever, and then leave it alone. And in terms of buying gold, you can start buying a coin here and there, but don't try to trade it because over time, things go, stocks will become positive. And in terms of gold, you want that insurance policy. I don't call investing in gold, I call gold an insurance policy from the follies of government leaders, which can treat currencies very badly, just like airlines treat frequent miles very badly, keep debasing them, and you find out you don't have what you thought you had. It's an insurance policy.
Do you think gold gets to 3,000 or 4,000 even at some point?
Yes.
Okay. Thank you all so much for being here with us. Appreciate y'all.
Thank you.